If you invested $10,000 into Palantir stock in 2021, you would have just $3,350 today. That is, if you put $10,000 in Palantir stock on January 1st, 2021, you will have lost 66.5% of your money in that time. So, how did it get here and what caused the company to lose so much of its value? That's what I'm going to discuss in this video. And at the end, I'm also going to say if this is a buying opportunity for people interested in Palantir stock right now. All right, so stay tuned. I think you're going to enjoy this video. So, part of the reason why Palantir stock has been falling ever since 2021 is because of the declining or decreasing rate of revenue growth. So, the company is still growing revenue, but the rate at which it's growing has been coming down. So, starting in January 2021, that growth rate was over 36%, and that increased to 48%, over 48%, near 50%. But ever since then, it's been coming down with each quarter it reports. So from 50 to 36 to 34, down to less than that, down to less than that, and all the way down to just 17.5% growth in its most recent quarter. So the rate of growth is important as well as the trend of the rate of growth, right? Investors see this and the market says, okay, well, the company is going to continue decelerating revenue growth and we don't know where this is going to end. Is Palantir going to come all the way down to being a low single digit growing company, or worse yet, is Palantir going to turn into a revenue decliner where revenue is going to decrease every year? So this is a major concern for investors in the market, and this concern, this risk, brings down the stock price, brings down the valuation. Okay. Now, if Palantir was to stop this trend and reverse this trend and show a few quarters of increasing revenue growth rate. Let's say next quarter it's 18.5%. The quarter after that it's 19.5%, and then 20%. If it can continue that kind of trend, it would alleviate some of the concern in the market about Palantir stock becoming a very slow growing company or even a declining company. All right, but that's not the case just yet. And so for that reason, it's bringing downward pressure on Palantir stock, and which explains why it's been down so much since 2021. Another reason the company's stock is down so much is because its lack of profitability. The company's been around for nearly 2 decades and it's been losing money nearly that entire time. Now, it's only been a public company for a few years, not that entire 2 decade time, but it's been losing money the entire time. So if you look at this EPS for the trailing 12 months, at its worst, the company was losing over $1.20 per share in the trailing 12 months. That improved to just 19 cents in the trailing 12 months. And the company made an incredible announcement, well, for shareholders, that is, saying that they will be GAAP net profitable for their current fiscal year. So for this whole fiscal year 2023, they said they're going to be GAAP net profitable. Now, if they achieve that feat, that would be tremendous and that would be a major boost to Palantir's share price and existing shareholders. If we look at net income instead of just earnings per share, you can see the company has also made progress in terms of improving its net income from a little over 1.2 billion to 373 million of losses on the bottom line for the trailing 12 months. So they've, cut their losses. What is this? From 1.2 to roughly 400. So by about two-thirds, they've cut their losses on the bottom line by about two-thirds. But if you look at earnings per share, they've cut that from $1.20 to 20 cents. So they've cut that by about 5/6, right? They've cut that by much more than they've cut the net income. So the difference between why earnings per share has made more progress than net income is because of this feature I will show here, and that is its average shares outstanding. So from 2021 to its most recent update, Palantir Technologies has went from, let's say, 900 million shares outstanding all the way up to 2 billion shares outstanding. So it's more than doubled its share count. Now what that means is that it's going to take the existing profits, which it says it will earn in the current fiscal year, and it will need to split that between twice as many shares. So shareholders will get half as many earnings, will be entitled to half as many earnings per share as they previously would have been before this shareholder dilution. So they've diluted your shares. And then eventually, if the company pays dividends, your dividend per share will be half what it would have been had the company not diluted shareholders by more than twice as much. Okay. So this is not good news for investors and shareholders of Palantir stock, because it splits your ownership and it dilutes your ownership percentage in the company. So whereas previously you would have owned a bigger slice of the company, your slice is now half as much as it would have been. So your ownership has decreased, and that's, nobody likes their ownership getting decreased, right? Now you would be willing to tolerate a lower ownership percentage if what the company is using the money for makes the overall pie bigger, right? You would rather have 10% of $1 billion versus 20% of $1 million, right? So you'd rather have a smaller share of a much bigger pie than a bigger share of a smaller pie, right? However, it's not clear that Palantir has used this shareholder dilution to shareholders' advantage, right? They're still losing a lot of money on the bottom line, and it remains to be seen if Palantir will achieve the goal of becoming GAAP net profitable in the current fiscal year. Now, if it does achieve that while not sacrificing growth to too large of a degree, then that will be an incredible feat. And I think investors would be happy with management for accomplishing that, even though they needed to dilute shareholders in order to accomplish it. I think investors would still be happy with that if this becomes achieved. All right. So to answer that question I posed at the beginning of this video, is this stock price decline in Palantir a buying opportunity? Well, let's look at the company's valuation, looking at its forward price to earnings ratio, looking at 1 year. It's trading at a forward PE of 32.93. The lowest, near the lowest it has traded for, according to this metric, going all the way back to January of 2022, where it was trading at over 80 in terms of this valuation. So given that it's making progress towards profitability, and given that the valuation is near the cheapest that it's been, I want to thank the Motley Fool for sponsoring this video. Visit fool.com/parkev for the 10 best stocks to buy now. I would say yes, this is a buying opportunity. If you're interested in buying Palantir stock, this is a good entry point for you right now. The valuation versus the profit prospects are aligned nicely, so you could go ahead and buy the stock. Now understand, this is a higher than average degree of risk stock. It's got more risk than the normal stock, but it also has a higher than average potential, right? It can return you a greater amount of shareholder returns. So it's sort of for the individual that's got a higher risk tolerance, willing to go for higher risk in order to generate higher potential returns. If that describes you, then Palantir could be the right stock for you. The valuation is certainly favorable at this moment in time, trading at a forward price to earnings of 32.93. All right, so that's all I've got for this video. If you like this, if you enjoyed this, I'm going to add a couple more to the end that I think you'll also enjoy. So please click on one of those, and I will see you over there. Thank you for watching.